Good morning, everybody. It's Monday, April 28th, 2025. I'm Herb Morgan, Chief Investment Officer and Senior Managing Director here at Cantor Managed ETF Portfolios. This presentation was designed to be used by both financial advisors as well as individual investors. Regardless of which you are expected to make your own investment decisions. Nothing contained in the presentation is advice, investment, tax, or otherwise. No recommendation for the purchase or sale of securities. The views expressed are mine and mine alone. They might differ from the views of CFIA's parents, affiliates, or other portfolio managers here at the firm. Let's get into it. Last week was a great week. Equity prices rose. Bond prices rose. Everything was up. You may not have noticed that if all you did was listen to the television news channels over the weekend, but we had a really great week. Why did we have a great week? Well, it was two forces at work. One, I think there's a growing sort of acceptance that there's going to be movement from the administration on trade policy, perhaps some announcements coming sooner rather than later about particular trade arrangements with certain countries. That would be welcome news to the markets. The other thing is that earnings are coming in much better than expected. And more importantly than better than expected earnings is that guidance is not being driven down, which was the big fear going into this earnings season. Not that Q1 was going to be bad, but that the CEOs and CFOs, as they reported, would guide the street down. For sure, some of that's happening, and they're talking about the macro uncertainty around trade, but no really big guidance downward. Some suspended guidance, which is probably prudent and wise, and the advice of some good lawyers at these companies, but no major downward guidance is infecting the preponderance of the S&P 500. Let's get into the data released last week. Much of it was better than expected. We'll start with S&P Global's flash reading for April for manufacturing. Manufacturing, 15% of the U.S. economy. Anything above 50 is growth. We got growth. The estimate was for 49. We got 50.7. So manufacturing appears to have grown in the month of April. Services, about 85% of the U.S. economy, came in at 51.4. That is also growth, a little bit below the estimate of 52.6. Both of these are flash readings. The final readings will be out this week, and I expect them to be little changed from the flash readings. Every Thursday, initial claims for unemployment, 5:30 a.m. my time, which is Pacific time. Weekly jobless claims came in at 222,000. Put that in perspective. Last time we were at this level was 1967. Labor force was about 2/3 of what it is today. So these claims as a percentage of the overall labor force remain low. They've been low, and this is one of the best real-time indicators I know of to tell me of the directionality of the U.S. economy. So we hear all this, the trade is going to destroy the economy, or this is going to destroy the economy, and don't get me wrong, there are many great risks. But they have not manifested themselves yet to the point where companies are so concerned they'll begin to lay off employees. That's when you sow the seeds for a recession, right? When you lay off people, they can no longer be consumers to the extent that they were prior to that. Durable goods orders also had a big surge, up 9.2%. The estimate was for 2%. If you back out transportation, big aircraft orders, they were essentially unchanged, but that's okay. This is a pretty good sign, a pretty good trend we're seeing over here in durable goods. Capital goods orders rose 0.1% as well. And we move into residential real estate. We got reports from both new home sales as well as existing home sales. New home sales are at the higher end now of a pretty crummy range, right? They've been in a very bad range since interest rates went up. The reason interest rates went up was basically to try to stem inflation, but also a realization of the over and excessive spending of the federal government as a percentage of GDP and the $2 trillion deficits. There's only so much money people are willing to loan, and that has driven up interest rates, which has significantly hurt the residential real estate market. Hasn't hurt values because we have a supply and demand imbalance there, but it certainly hurt the folks that are on the front line trying to make, build, and sell new homes. In March, however, we gained 7.4% on the rate. It's the higher end of a very low range, as I mentioned. We move on to existing home sales. They remain miserably low, down around the 4 million annualized units. That's down from 6.5 million annualized. That's a big drop, as you can see. This was during the ultra low, artificially low, right? Violent intervention into the marketplace by the central bank and by the Treasury in the terms of the fiscal stimulus, sent interest rates to all-time low, distorted the market, drove prices higher as financing costs were next to nil, quite frankly. University of Michigan's reading on consumer sentiment, another soft piece of data where home sales are hard data, weekly claims for unemployment are hard data. But when you start talking about sentiment, how do people feel, it is soft data, and they don't feel pretty good. They don't feel pretty good at all. Consumer sentiment for April, according to the University of Michigan survey, fell from 57 to 52.2. Better than expected, but horrible. Current conditions fell to 59.8, future expectations at 47.3. Think about it. We're below where we were during the COVID shutdowns. Now, my sentiment was quite a bit lower during the COVID shutdown. My sentiment around earnings, around the consumer, around inflation, all the things that they were sowing the seeds for at the time. And here we are today, actually getting, down lower than that level. But this is soft data. So will the soft data lead the hard data lower? Some people think yes. Or will the hard data and some maybe better sort of news on the news cycle turn that sentiment data higher going forward? That is the $64 question at the moment. The other thing that really helped last week, right? We had a sort of de-escalation in some of the sentiment around trade rhetoric. We have hints that deals are coming. We have hints that discussions are ongoing. All of those things helped to remove a lot of the downward pressure on equity prices. The other thing, and I think probably the more important thing, is earnings. Earnings reports are coming in just fine, thank you. 178 out of 500 companies have reported, and 133 of those have beat the earnings estimate of analysts with an average earnings surprise of 10%. Look at a place like technology, 8, communications, 25 or 24.6% earnings beats. The big question going into earnings season was there was not a lot of analysts thinking they would be poor. There was a lot of analysts thinking they would be okay, and then they would guide down the prior guidance. To be sure, we've had some companies remove their guidance. We've had some companies guide down, but nowhere near to the extent feared. In fact, if we dig deeper into the earnings report, which I'm about to do now, we see that things look quite good. And that is, in my view, the reason stocks stopped going down more than anything last week. First of all, the total EPS estimate for the first quarter is now higher than it was a week ago. And it's higher than it was at the beginning of the month before any earnings had reported. So, okay, companies beat, and then you say, okay, well, that takes the estimate a little bit higher. Q1 now looks to have, it's not in yet, it's not done. We have a lot of companies this week. We have 180 companies this week, but it now looks to be 10% earnings growth quarter to quarter for the second consecutive quarter. 64% of companies are beating on the top line on higher revenue. That's right in line with the 10-year average. It's a little bit below the 3- and 5-year average. Q2 to Q4 estimates, we're in Q2 now, are now expected to grow at 6.4, 8.8, and 8.3, and the total yearly growth for 2025 is expected to be at 9.7%. I'm not sure how anybody could draw the conclusion of a recession with almost 10% year-over-year earnings growth. The forward PE multiple is now down. It reached 23 when I said, hey, I'm getting concerned and I think we could have a little correction, a 10 to 15% correction. We're at a 23 multiple. We're now down at 19.8 forward earnings. Forward earnings still includes Q1. Well, if Q1 rolls off here very soon and Q1 26 rolls on, and that number should be much higher than Q1 25, it should be 10 to 12% higher, you can see how that drives that forward multiple even lower. We have 180 names reporting this week, as I mentioned. Of those, 4 of the big dogs, Apple, Facebook or Meta, Amazon, and Microsoft, all reporting this week. But what's affecting consumer sentiment and what's affecting news cycle sentiment, whether it's financial news or political news, they really spent a lot of time focusing on the potential downside to failed trade policy initiatives. Of course, that's possible. Initiatives can fail. But what they're not talking about is what I believe is the biggest clear and present danger to our portfolios. And this is far more concerning to me than whether or not the trade policies will work. Because if the trade policies don't work, as quickly as the president added a tariff, he could remove a tariff. This is just voluntary experimentation with the economic situation. But here's the reality. The U.S. Treasury has $6 trillion in debt that matures in the next 12 months. Imagine if you had a very, very low fixed rate mortgage that was only for 5 years, and you took it during the 2020 COVID pandemic when interest rates were near zero, and you got 2%. You were very excited about it. And over 5 years, now it's going to start adjusting. And when it adjusts, it's going to go to, let's say, the 1-year T-bill plus, or the 1-year SOFR plus, or LIBOR, it probably was at the time, but LIBOR is being phased out. Regardless, your interest rate is set to double. Well, the U.S. government back in 2020 and 21 did exactly that. It took out extremely low-rate debt financing. I have T-bills in my customer accounts here of 0.3, 0.4, 0.5%. Now, we bought them at big discounts, but these are very low interest rate securities. They are coming due this year and next year, really the next 12 months. They must be refinanced. They're not being paid off. The government isn't running a surplus. To pay down debt, you need a surplus. So the revenue comes in. We're running a $2 trillion deficit. So not only do we need to refinance $6 trillion, we need to borrow an additional $2 trillion. So that's the same as borrowing $8 trillion. Nobody's ever borrowed $8 trillion in a 12-month period before. This is the biggest risk, and this is where we should be focusing our attention and our worry about what could go wrong. Now, I do feel confident in the person at the head of the Treasury, Scott Bessent. I do feel that they are aware of the situation. I do feel that Congress is aware of the situation. I do feel that DOGE is a start to perhaps address some of this situation. But one way or another, the U.S. Treasury must refinance $6 trillion and borrow an additional $2 trillion over the next couple of months, or over the next 12 months. If they were to eliminate the deficit, they still need to refinance $6 trillion. This is very, very serious, far more serious than the trade situation at hand. Okay, moving along. Economic data this week, plenty of it. House prices, job openings, consumer confidence, the 2 big employment reports, Wednesday and Friday from ADP and the Bureau of Labor Statistics. We're going to get a soft GDP print for the first quarter. Don't listen to what you hear. This is going to be soft because there was a massive surge in imports to people trying to get ahead of the tariff implementation. In addition to that surge in imports, you're going to have government spending slow down because so much was pushed out in Q3 to try to help the incumbent administration with GDP figures. I wouldn't worry about that. I'm not worried about that. PCE price index, that's a big one. And if that comes in at 0, that's very positive for the markets and the economy. Gives the Fed room to consider lowering rates, which would make the president, the administration happy given their $6 trillion problem. Thursday, weekly claims for unemployment, ISM manufacturing, S&P. These are the final readings. Construction, auto sales. As I mentioned, the BLS jobs report on Friday. Thanks, everybody. I'm available on all the audio podcast formats. The best place to catch me is on YouTube. The name of the program is Slaying Bulls and Bears. We make the complex and complicated simple and sensical. Thank you, everybody. I'll see you again in 1 week.